Welcome to our channel. Today we are going to talk about a secret that might make your high school career counselor have a minor heart attack. We are exploring the philosophy of a man who believes that being lazy, strategically lazy, is the absolute best way to become a billionaire. We are talking about Warren Buffett, the man who looked at the chaotic, fast-paced world of Wall Street and decided that his favorite holding period is forever. In a world where everyone is screaming about day trading, crypto moonshots, and checking their phones every 5 seconds for a price update, Buffett's approach is like a calm breeze in a hurricane. He firmly believes that lazy rich people tend to get even richer, while the active ones often watch their assets slowly leak away through bad decisions and transaction costs. Let us take a trip back to 1991 to see this in action. At that time, Coca-Cola made up a staggering 50% of Buffett's entire investment portfolio. Think about that for a second. Half of his wealth was tied up in a company that makes brown, fizzy water. Why? Because he had an extreme level of trust in the brand's power, its massive market share, and its potential to keep growing globally. He wasn't looking to flip the stock for a quick profit. He believed that buying a stock is exactly the same thing as buying the entire company, and he had zero interest in selling a truly excellent business just because the price went up a little. This highlights a core principle. As your wealth grows, the number of truly great opportunities actually starts to shrink, which means when you find a winner, you have to be willing to bet big and then sit still. But how do you avoid the trap of being too active? Even some of the smartest people in history have failed at this. Take the famous economist John Maynard Keynes, for example. He was a literal genius who helped shape the modern global economy, yet he once completely blew up his own brokerage account. When he sat down to figure out what went wrong, his conclusion was simple. He was just way too active. This lesson stuck with Buffett. It reinforced his belief that you should only have 2 or 3 companies that you are truly, deeply confident in at any given time. If you spread yourself too thin across dozens of companies you barely understand, you are just gambling with extra steps. Now, let's get into the nitty-gritty of how you actually find these legendary investment opportunities. Buffett doesn't use a crystal ball. He uses a very specific logical framework. First, you have to set a goal that makes sense. He suggests aiming for a 15% annual return. Once you have that target, you look at your net assets and do the math. If you happen to have $20 million and you want that 15% return, you realize you need to find $3 million in profit every single year. This turns the abstract idea of making money into a concrete mission. Once you know your target number, you start looking for projects that can fill that bucket. If you find a project that offers a 5% return, you know you need 3 of those to hit your 15% goal. This approach allows for a controlled version of diversification where you aren't just buying things randomly, but rather assembling a puzzle where every piece contributes to your specific profit requirement. He encourages us to view ourselves not just as individuals with a bank account, but as our own personal holding companies. You are the CEO of your financial future, and your job is to look for long-term profit contributions over a 10-year cycle, rather than worrying about what happened in the market this morning. In the Buffett world, the scoreboard doesn't matter as much as the game being played on the field. He uses a baseball analogy here. He says you should focus on the players running around the bases, not the blinking lights of the score digits. If the business is running well, the profit will eventually show up on your balance sheet, regardless of what the market thinks today. Short-term fluctuations are just noise that distracts you from the long-term goal of total profit growth. But what exactly makes a business worth holding on to for decades? Buffett separates the world into good businesses and ordinary businesses. A good business has 3 distinct characteristics that act like a protective moat around a castle. First, the product or service must be something people highly demand or even crave. He points to companies like Nvidia, Apple, or high-end brands like Mutai and LV. These aren't just things people buy, they are things people feel they need to have. Second, the product needs to be irreplaceable. When a customer feels like there is no real substitute for what you are selling, you have gained an incredible amount of power in the marketplace. And finally, the ultimate sign of a good business is pricing power. A truly great company can raise its prices periodically to keep up with inflation or just to increase margins, and its customers won't run away to a competitor. If you find a business that people crave, that has no substitutes, and that can raise prices at will, you've found a gold mine. Of course, It's easy to talk about holding forever when the sun is shining. But what happens when the clouds roll in? Right now, a lot of people are terrified of a looming economic recession. Financial experts at Goldman Sachs recently raised the probability of a recession to 30%. And some others, like those at Moody's, I think there's a 49% chance we hit a downturn in the next 12 months. This kind of news makes most people want to sell everything and hide. But for the Oracle of Omaha, a recession isn't a disaster. It's a massive flash sale. Back in 2008, when the world felt like it was ending and the S&P 500 had lost nearly half its value, Buffett wrote a famous piece for the New York Times telling everyone to stay calm. He shared his most famous rule: be fearful when others are greedy, and be greedy when others are fearful. He reminded everyone that despite a century of wars, panics, and depressions, the market has always continued its long-term growth. He views bad news as an investor's best friend because it allows you to buy a piece of the future at a significant discount. Think about the math of waiting. If you had invested in a Vanguard S&P 500 ETF 5 years ago, you would have paid about $359 per share. Today, that same ETF is trading near $598. While people who bought years ago are enjoying those massive gains, people who were waiting for the right time are now facing a much higher entry price. If a recession does hit and prices drop, it shouldn't be a time for panic. It should be a time to celebrate because you can finally buy those high-quality assets for a fraction of their recent highs. The danger of trying to time the market perfectly is that you often end up sitting on the sidelines while the best growth happens. There is a huge opportunity cost to waiting for a recession that might not even happen in 2026. The longer you wait, the more time you lose for your money to grow through the power of compounding. If you get scared and pull your money out when prices dip, you might miss the most important recovery days that drive long-term wealth. So, what is the final takeaway from the Buffett School of Wealth? It's that the most successful investors are often the ones who do the least. They spend their time researching and thinking, and then they make maybe 2 or 3 big moves in a decade. They look for businesses with that magical combination of high demand and pricing power. And when the rest of the world is panicking because of a headline about a recession, they are looking at their watches and waiting for the market to go on sale. Success in investing isn't about being faster than everyone else. It's about being more patient. It's about recognizing that you are a holding company and your job is to collect great businesses and then let them do the hard work for you while you sit back and be lazy. If you can master the art of doing nothing while everyone else is running in circles, you are already halfway to the finish line. Thank you so much for joining us today for this deep dive into the mind of Warren Buffett. If you enjoyed learning about how to be productively lazy and why bad news might actually be your best friend, please make sure to subscribe to our channel. We have plenty more insights and strategies coming your way to help you navigate the complex world of finance. And don't forget to hit that like button. It really helps the channel grow and ensures we can keep creating this content for you. See you in the next video.